If you are looking for a way to learn how to trade the forex and the cryptocurrency market, then welcome to Cloud9 Trading. If you are new to the channel, my name is Mahama, the author of the book The Future of Money and Investment that has sold over 10,000 copies worldwide. So don't forget to subscribe and click the notification bell. Trading the forex and the cryptocurrency market is a probability game. So when you are taking a trade, or when you are about to take a trade, you want to stack as many odds or as many confluence factors in your favor as much as possible before taking a trade. So today we'll be taking a look at how to apply so many confluence factors before you take a trade. So what we are going to actually do is we'll be taking a look at a multi-time frame analysis to identify the direction of the market. We'll also take a look at market structure to identify key levels in the market. We'll also take a look at our Fibonacci tool. That is, we'll be using our Fibonacci tool to confirm the key level we have identified. And also, we'll be looking at our trade setup, that is the chart pattern for our trade setup, and as well as using an indicator to confirm that particular setup before we take our trade. So we'll be stacking all these factors on top of each other. The currency pair we'll be using for this demonstration is GBP JPY. And this is actually a trade I took about 5 weeks ago that yielded about 1:8 raised to the world. So in the video, I'll be explaining each step I considered, each factor I considered before taking a trade, and the reasons why I considered those factors before taking a trade. So without wasting much of your time, let's get straight into the chart.
Bitcoin bitch, Bitcoin only cause I got that mad cheddar. Bitches and Bitcoin go so good together. Make it rain with Bitcoin cause I like it way better.
Alright, we are starting our analysis from the weekly time frame, and we are trying to learn how a trader you can combine market structure, chart pattern, Fibonacci, and also an indicator to take high probability trade. So this is the area we are going to look at. We are going to look at how a trader you could capitalize on this move to the upside. That is just within that region, this region. How as a trader you could capitalize on that move. So let's get started. So let's use our replay tool. When the market was around here, what was happening? We could see that the market was rejecting a resistance around here, and we could also see that the market was creating a W formation, that is a W pattern here. The market also created a W pattern, and you know that after a W pattern, expect the market to retrace to the neckline. So when the market was here, we expect the market to retrace to at least this level. Let me mark it out to at least this level here before we can take our trade to the upside. So let's go to our daily and see what is happening in the daily time frame. So when we come to the daily time frame, here we are interested in two things. The first one is our Fibonacci level, and the second one is our structure level, and we will then combine these two to determine the level that we are most interested in. This is what I'm trying to explain to you. This is our Fibonacci, and when you look at the Fibonacci, in the Fibonacci there are 5 levels. So as the market is coming down, it can stop at any of these levels. So let's also determine our structure here. And with the structure, we are not interested in every structure that is in the market. We're interested in the key structure that the market has respected several times, that has been holding the market either up or down. That is the area we are most interested in. And when you look at our area, the structure level, is line up with this level here. When you go back in the past, you can see that this area was a resistance, broke above, then as a support, respected for the first time, here for the third time, here as a resistance for the fourth time, for the fifth time as a resistance, sixth time as a resistance, seventh time as a support, another seventh time as a support, and broke above. Then it has also broke below, then here again it has broken above. So we expect that it will act as a support around this region. So around this region here, we expect that it will act as support around this region. And when you combine our Fibonacci levels with the structure, you can see that the Fibonacci level that lines up with the structure is the 50% level. So in this case, we are only interested in the 50% level. That means that this is what we are expecting the market to do. As the market comes down, we expect the market to get to the 50% level before making a move up. So we have identified our two things in the daily. The next thing is to wait for market to get to this level. So let's play our replay tool. Okay, the market has gotten to our level here. So what are we supposed to do again? At this level, we are not taking a buy straight away. We will go to our 4-hour and below time frame, that is the 4-hour or the hourly time frame, and look for entries. Always remember the weekly and the daily are for direction, whilst the 4-hour and below are for entries. Alright, going to our intraday time frame, that is our the 1-hour time frame. Let me remove these things first. Okay, let me move the Fibonacci level 2, and let me remove this one also. So we are leaving the market at this level. This is where we are interested in. So we'll go to our 1-hour time frame. So we'll move all the way to that place, and it's exactly here. So now we can now remove it. So when we come to this area here, we are looking for what? Two things: a reversal pattern, and second one is break of structure. A reversal pattern is for us to determine when to make an entry, and the break of structure will show us when the market environment has turned from a bear market to a bullish market. So let's do what we are supposed to do here. So from here you could see that the market was in a downtrend all the way. From here was in a downtrend, making lower highs and lower lows all the way to this area until the market got to our area of interest here. When the market got to our area of interest, it made a lower high here, lower low here, another lower high here, and first made what? A lower high. It didn't make a lower low again, it made a lower high. So this was the first sign of market direction changing. And from here, another thing, when we come here, what we are going to do is we'll apply our indicator, that is our RSI. And what we are looking for in the RSI is simply divergence, nothing else. So look to see whether we have divergence on the RSI. So let me add the RSI for us to determine our divergence. Okay, see, the market was coming down, so the market was making what? Lower lows here, and the market was here,
instead of the indicator to make lower lows, it was making lower highs. So as the market was going down, the indicator was going up, which was telling us that the momentum of the market is now shifting towards to the upside. So let's remove the RSI and go back to the naked chart. So that's our first confirmation. As the market came to this level, that was our first confirmation that there might be a possible sign that the market will go up. The second one is this level here. Let me mark it out for you to see it clearly. You see these levels here. When the market broke below this level, it tested it here, came back and tested it here. So this particular lower high here and this particular lower high was what was keeping the market down. So until the market broke above that lower high, there was not what we call a change of direction in the market. We could have still made move down all this way, but until the market broke below here, broke above here, that was when the market started changing direction. So that is the second thing. The third one is when you take this when you draw this trend here, you can see something has popped up, has come to light. That is what we call it the ascending triangle. Let me zoom it out and you see. You can see it very clearly here. See, the market came all the way here, came back and retested that region again, came here before breaking out, and you can see all this region here has created a pattern called ascending triangle, and an ascending triangle is a bullish pattern. That was our third sign that the market might be moving up. And the fourth one is when the market actually broke above and came to this high here. So around this high, around this level was when we had the confirmation that we are going to go up. And the third confirmation was to add another indicator. The fifth confirmation was to add another indicator that we call the Ichimoku Cloud. Let me add it for you to see. And the Ichimoku Cloud, the purpose of the Ichimoku Cloud is to see if your trading rules, in a sense that you don't trade haphazardly. When you add the Ichimoku Cloud to your chart, you only do two things. You trade, you sell the market when the market is below the Ichimoku Cloud, and you buy when the market is above the Ichimoku Cloud. So from all the way when the market was coming down, from all the way here, you could see that the market was below the Ichimoku Cloud all along until this level when the market broke decisively above the Ichimoku Cloud. So from here, the fifth one, the market broke above the Ichimoku Cloud. So now what are we waiting for now? We are waiting for a retest of our ascending triangle before we take our trade. So from here, we are waiting for a retest to this level. So here was our first area we could take our trade. So in taking our trade, this was the first area we could take our trade. And how do we take our trade? One, this will be our target here. Why is that one our target? Because that is the previous high in the weekly. Remember, we determine the direction from the weekly, so expect that the market will get to that level again, and we'll keep our stop loss below the cloud. Why do we keep it below the cloud? Because when you keep your stop loss below the cloud, you are indirectly telling the market that if the market falls below the cloud, that means it's going to go down, so it should take you out of the market. That is the logic behind it. So from here we could get a 1:6 risk to reward, or we could wait until here when the market presented another opportunity, then we'll take another trade again, then we could get another 1:9 risk to reward. Sorry, it should be rather 1:8. 1:8 risk to reward when you put it below the cloud. So that is how you apply so many layers of confirmation to your trading, so that you get the best out of your trading. So thank you for watching, and make sure you subscribe and share this video